Thanks for clicking. The Bank of Canada is set to raise interest rates next week, with many saying that a 50 basis point rate hike is almost guaranteed, especially as Canada's inflation rate came in at 6.8% for the month of April. This comes at a time when Canada's real estate market is going through what looks like a major slowdown, due in large part to an increase in mortgage rates. With the Bank of Canada having already raised interest rates by 75 basis points this year, and mortgage rates following suit, housing affordability have stretched the wallets of many first-time homebuyers.
Yeah, well, we needed it.
So what I want to do today is go over current mortgage rates ahead of the Bank of Canada's announcement, as it looks like they're only going to be going up further for the foreseeable future. Then I'm going to look at how these rates have affected affordability, as there's definitely some welcome surprises for first-time homebuyers, with affordability inching up a little bit.
It's about time.
Then we'll take a look at what to look for next. Speaking of what to look for next, we are expecting a big week in Canada's real estate market next week, with the Bank of Canada set to make its rate announcement on June 1st, and we'll also be getting in the real estate data for the month of April from Canada's real estate boards, where many are expecting that our prices went down even more. Well, obviously I have updates on those on this channel. Click like and subscribe to get those updates, but for now, let's get into these mortgage rates. Interest rates have gone up quite a bit in the last couple of months, starting with the best insured mortgage rate, insured being where there is a 25-year amortization, less than 20% down, and you qualify at 2 points above the contract rate, the rate you're paying. The best insured mortgage rate we had in March was 3.39. That went up to 3.99 in April, and as of right now, the best insured mortgage rate is 4.19, or about 0.2% higher than it was in April and 0.9% higher than it was in March. The best insurable mortgage rates have also gone up in the past couple months. If you'll remember, insurable rates are where you qualify based off an insured qualification standards, so you do have that 25-year amortization and 2 points above the contract rate, but you have 20% down. So if we look at March, the best insurable rate was 3.59. That went up to 4.19 in April, and now is up to 4.54 in May. Definitely a large jump from March's 3.59. Again, almost about 1% increase in 1 month. Next up, the best uninsurable rates. Uninsurable rates are when you either use a 30-year amortization and have 20% down, or anytime that you take money out of your house vis-a-vis a refinance, and those rates have also gone up quite substantially as well. The best uninsurable rate in March was 3.49. That went up to 4.29 in April and is now at 4.74 in May. 4.74 uninsurable rate, so we're already getting close to a 5% uninsurable interest rate. If you have a 30-year amortization, you're looking at close to 5%, and that's just in a period of a couple of months. I remember very close to this time last year, probably around March, doing a very similar mortgage for 1.84. So we can see in the past year, rates have gone up substantially. And just with the insurable rates, we're up over 1% in just the period of a few months. So rates have definitely increased across the board, and we're really starting to see the effects on the real estate market here in Canada. So real estate prices are down, mortgage rates are up, but what has this done to affordability? If we look at the average price of a house in March, when it was $796,000, and we use minimum down payment requirements and a 3.99 interest rate, the payment for that average house was $4,065. Now, if we look at April's average house price of $746,000, because remember, house prices went down about $50,000 in April, and we use a 4.19 interest rate with minimum down payment requirements, the payment is $3,899. So even though interest rates have gone up, house prices have fallen to the point that to buy this average house in Canada, you're paying about $260 less than you would have had to in March. So rates have gone up significantly in the past few months, but when rates go up, prices fall, and we can see the affordability of houses start to vary. With that said, although houses have become more affordable just using this as an example, if rates go up much further, this whole situation could flip again. Using the above example, with an average house price of $746,000, if interest rates say go up to 5.19 up for 4.19, then that payment goes back to $4,314, or about $150 more than it was in March when prices were higher. And this is going to be a major feature of Canadian house prices and Canadian affordability going forward. As our interest rates go higher and higher, our prices are going to go lower and lower. It may or may not make house prices more affordable. That's why I always recommend to get those pre-approvals in, get something on paper from your mortgage lender saying you are locked in at this rate for the next 120 days. So hopefully in say 2 months after you get that locked in rate, if you're able to purchase a house at that lower price, you still get the interest rate from a few months ago, thereby increasing your affordability. We're going to continue to have updates on this channel on the ebbs and flows of affordability every month when we take a look at the mortgage rates. If you want to get those updates, make sure you click like and subscribe, and thanks so much for watching.